Good afternoon, everyone, and thank you for reading through those disclosures and welcome to another one of Avant-Garde's free educational trading webinars. We are happy to have you here this afternoon and thrilled to welcome Vlad Karpel as well as Keith Harwood with us both here today to talk to you all about how to fix your broken trade. So a lot of good information forthcoming. We are ready to begin. Vlad, Keith, are you with us?
Yes, we're ready.
Thanks again,
Ready
Natalie.
to go. Amazing. Yeah, thanks so much for being here, everybody. Vlad, you can go ahead and pull up your presentation and share your screen. While you're doing that, I'll just remind everyone here live with us in the Zoom room, if you have questions during the presentation, please type those questions into the chat box or the Q&A, and we'll get those questions over to Vlad or Keith to address.
All right, let me know if you can see my screen.
Yes, I can. Looks good, Vlad. Feel free to take it away.
All right, again, thank you, Natalie, for giving us the opportunity to present. Super excited. Right? This is a very interesting topic. A little bit more advanced options trading. Right? We start with single calls. We talked about verticals, butterflies, ratio spreads. Not a lot of people trade ratio spreads, but I think hopefully after today's presentation can help you at least consider it going forward. Especially if you are trading stock, you like to do cover calls, and the trade goes against you, right? So, and market has been volatile, right? Usually in the fourth year of the bull market, right? We had the recession in 22 when the interest rates were rising. We had a pretty sharp pullback. At least maybe the economy was in a recession, but at least the markets were in a bear market. And 2026 is year number 4 in midterm elections, and historically, you should at least consider expecting, anywhere from 10 to 20% correction in the next 12 months. So hard to predict when it's going to happen, but when it does, you want to have tools, right? You want to know how to hedge your portfolio, how to repair some of your trades if the trade does go against you. So that's kind of what we're going to talk about and prepare for the future. Because volatility is here to stay, and it could happen in December of this year. It could happen in January, February of next year. It's hard to tell. For those of you who are new, I see a lot of familiar names, at least, maybe not faces, but at least names. A little bit background. My background is that predominantly is in technology. So I have master's degree in computer science. I've been building technology for hedge funds, for broker dealers for over probably 25 years. When Options Express was a broker dealer, it went public. So I decided to manage my own money. I've been doing that, for the past over 20 years, building technology for retail investors, for institutional investors. And then when I started Yellow Tunnel, I decided to share my knowledge and skills in building technology and managing my own portfolio. I've been doing that for a very long time. And in the past year and a half, got lucky to work with Keith Harwood from Options Hotline, who's helping us to manage live trading room, but also manage us with the strategies and optimal option strike price selection, expiration months. He's an ex-market maker, so he has vast knowledge of options trading. So that's my background, and I do we have a team of financial engineers that build in AI models. We've been doing that for many, many years before ChatGPT. Keith, you want to give a few?
Yeah, absolutely. Yeah. So you kind of touched on it. I've been trading for a little bit over 20 years now. After graduating college, I started as a market maker down on the CBOE floor. So I've been managing large options books for, I guess decades now. So after working through as a market maker through the subprime crisis, where there were a lot of broken trades, of course, I moved over to trading just about the whole gambit. I've traded European bond options. I've traded precious metals futures options, as well as the ETF options. Worked for a hedge fund doing a lot of their option strategies. So they had a directional bias. I worked with them on the directional bias and the option structure that fits best with that directional bias. Really been focused a lot on implementing option strategies given a directional or an anti-directional trade bias. So a lot of this really works well with Vlad and all of the AI tools and everything that he's developed, because those tools help predict movement, and then I can work on a lot of the option structures that maximize the expected value given that potential expectation. So really excited to work with Vlad on a lot of this stuff that we've been working on. Our trade room and everything else has been just a wonderful synergy. So looking forward to talking more here today.
Great, thank you. You already went through disclosures for AGT's broker-dealer disclosure, so this is very similar. I'm going to go through specific trade ideas, for educational purposes only. Please, if you haven't visited optionsscreening.com, I encourage you to visit it to understand the risk and suitability associated with trading stock and options. All right, so what happens when the stock goes against you, right? Bitcoin was a perfect example, right? Beginning of this year, everybody thought we're going to go to 200,000, right? And I mean, we did have a pretty significant rally the first half of the year. And then for now, I think 30-40% pullback from, all-time highs. So very popular instrument, right? Everybody's trading Bitcoin. There's a lot of liquid ETFs now that you can trade without owning, Bitcoin, but doing it through ETF or options. And we've seen some of the high-flying AI stocks, right? Palantir, Iran, stocks that did pull back 30, 40, 50%, even without the bear market, right? And we've seen some of the price actions. So then what do you do, right? I mean, you have several choices, right? You sell your positions, right? Choice number one, right? You put a stop order. My position is down 10, 20%, 5%, depending on your time frame. Do I close position? Risk aversion, right? A lot of us are risk aversion, right? We talk about yellow tunnel trading psychology is important, right? Prospect theory, where we have different relationship with money and different reaction to when the trade goes in our favor versus against us, right? So more often than not, especially if you're a beginner, in the beginning of your journey as a trader, you hold and hope, right? You hold the Bitcoin because it dropped 30, 40%, but it's always going up. So you hope that it's going to get back and reach 200,000 level by end of 20. If it didn't do it in 25, then maybe 26, right? A lot of times people double down, right? They have a Bitcoin position, it's down 40%, they buy more, right? And the fourth choice is repair your stock by reducing your break-even point without taking additional risk, right? Ideally, you want to be able. If the Bitcoin is down 30% or 40%, what can I do without taking additional risk on Bitcoin? But instead of a stock now, almost doubling, right? Because 34% from all-time high, the stock has to, go significantly higher to get to the break-even point without taking additional risk. So that's the goal for today. So ratio spreads, right? The repair strategy is built around an existing losing stock position or ETF position, right? And it's constructed by purchasing one call option, right? You buy one call option and sell in two call options, right? So you have 100 shares of stock that you already own, right? Or 100 shares of ETF, right? Bitcoin ETF, IBIT, or some of the other popular Bitcoin ETFs. So you already have 100 shares of stocks there. It's down 10%, 20, 30%, depending on your entry point. So then you would buy one call option, right, and sell two call options. So one short option would be against your long call, and one short option would be against your 100 shares, which is basically a cover call and a debit spread. You can think about that way, right? You have a cover call and a debit spread. Ideally, you want to do it for net credit. We're going to defer it to Keith. Sometimes it's hard to do it net credit. You have to go further out to get net credit. Sometimes you can do it for small debit. I personally, don't like to wait 3-4 months. Sometimes you have to go into March, right, or June to get credit for that break-even strategy. So if you want to do it shorter dated options that expire in 40, 50 days, then you might do a small debit. Final position is a free option position that lets you break even on your original investment of that 100 shares of Bitcoin stock a lot faster, right? and by lowering your break-even point, right? Because you want to be able, if you bought Bitcoin when it was at 130,000, can you repair it so you break even when it's at 110, right? Or 105, right? Instead of waiting to 130,000 without taking additional risk, right? Without taking or limiting, if it's a debit, if it's a net debit, small risk. So this is the original, stock diagram, right? If you just buy 100 shares of stock, it goes up. If Bitcoin goes from 100,000 to 200,000, then great. And if it goes, from 130,000 to 80,000, not so great, it's a linear relationship. So in this example, I did actually not hypothetical Apple, or any other stocks, 100 shares at $100. So I mean, Bitcoin, it could be Bitcoin, right? You buy 100 shares, you bought it when it was 110,000, or if it's ETF, maybe, depends on ETF, could be at $110, right? So the stock drops to 100, right? You're down $10. And the idea is that you buy one contract of 100 call, right? Because it's now dropped to 100, and you sell two contracts of 110 calls, right? So if it's a Bitcoin, then you would go to January. Ideally, you would want to do it for a small credit. If you go to January, you probably won't be able to do that, depending on volatility and skew. So you might have to do it for a small debit, right? If you do want to do it credit, you could do this, but then you might have to go to February or March. And the idea is that you just shift in break-even point. And this example is actually not 102.5, it's 105. So in this example, if you buy 100 shares of Apple at 110 and it drops to 100, to break even, it has to go to original price, 110. But if you buy one contract, 100 call, and sell two 110, then your break-even point would be 105, right? Your break-even 105. So what happens, right? So if stock stays at 100, doesn't move or fluctuates, right? By January, maybe we have some unemployment is rising, maybe AI stocks are overvalued, but we're just kind of trading sideways. We've been trading sideways for the past, few months, right? Between October, November lows and all-time highs. We could be trading till January, continue trading in that range, right? So if you did this originally for a credit, small credit, and you keep a credit and nothing happens, right? If you did it for a small debit, then you would lose that small debit. If stock goes to 105, you basically make $5, on that 100 call that you bought, right? And so this is the point where you basically break even because you're down $5 on the stock because you bought it at 110 and now 105, but you made $5 because the stock is now 105. If Apple goes to 110, then you break even on your original investment, but now you're making money on that long call, right? Your long call, and then anything beyond 110, if you did one stock, if you had 100 shares of stock and you had a ratio call spread, then it's kind of think of it as a cover call. At that point, you're not making any more money, right? You made $5 on overall trade. So that's the only downside to the strategy, right? If Bitcoin goes to 140,000 and you did the strategy, yeah, you lower your break-even point, but you're minimizing, you're capping your overall gain, similar to cover calls. Even if Apple or Bitcoin goes to 95, in this specific example, then you just down another $5 on your initial investment, and depending on if you did it for small credit, then at least you receive that credit for that ratio spread. If you did it for a debit, then you're also losing a small debit. So I went to Winston, our friend Winston, on AGT, right? And basically ask a few questions, right? And basically, can you give me an example of ratio call spreads, I misspelled it, strategy and risk versus reward chart, right? So, and it says absolutely, right? So, and give us actually the same example that I provided. That's very interesting. I guess even numbers. So you buy one, again, just to recap, buy one call option at the lowest strike, $100. You sell two call options at higher strike price, 110, and all options have the same expiration date. This creates a position that profits if the underlying stock rises moderately, but expose you to unlimited risk. Because if I just do ratio call spread, a lot of people just trade ratio call spread. If you don't think that if you think Bitcoin is going to trade in the range between 80,000 and let's say 130,000, right? If you're selling that strike, that upper strike, whatever and you don't think it's going to go too much far away from that level, then you're going to make money on that ratio spread. But if you don't have original stock and it goes beyond your strike, right? So that's where that second option is naked, basically. And usually you don't want, we would. This is someone like Keith. He can do it, right? Because he can be short naked calls. Usually in our when we do live trading room, I advocate never be naked calls or never be naked puts, right? In this example, you are naked. That's what Winston is saying. But in the original presentation that I said, the idea is that you already have 100 shares of stock, right? And it gives you different scenarios. If stock trades below zero, all options expire worthless. Loss is premium paid, right? If you pay that small debit as opposed to credit. If you did it for small credit, you keep it. If the stock is between 100 and 110, profit grows, right? The stock rises and stays between that 110 range, then your maximum profit is at 110. If stock goes above 110, this is when you have unlimited risk on your short calls. That's why we say don't trade short calls. But if you had original 100 shares and you uncover call, then it's a profit loss diagram of a cover call, right? You're just capping your maximum loss. So this is an option. So ratio call spread is an option strategy that involves buying a certain number of call options. It's repeating it, okay? And then so takeaways. Ratio call spreads can be attractive for neutral to moderately bullish views, but requires careful monitoring if the underlying rallies. If you already have 100 shares, you don't need careful monitoring because you're not naked on these short calls. And then I said, can you show payoff diagram? No. When should I use ratio call spread? I don't know why I keep misspelling. Consider ratio call spreads. Market will use the strategy when you expect moderate upside in the underlying assets, but not a huge rally, right? If you think you're going to have a huge rally, then you kind of do the opposite, right? You sell one short call, lower strike, and then you buy two call. So if you do very popular strategy during earnings, right? If you think this, Oracle is going to go up 40% during earnings, then you can sell call, lower strike, and then you could buy two calls, higher strikes, and then you want, three standard deviation move. So you have to be careful which strikes you're selecting and, what the ratio is, So I propose never be naked, right? And if you want to do ratio spreads without the stock, then you do it on stocks that, AI stocks that announce earnings and you think they're going to go to the moon. Okay, then that's great. Or Bitcoin, right? If you think Bitcoin is going to be 200,000 by February, okay, great. Then you would sell one call, and maybe buy two calls further out of the month. Investment works best when implied volatility is at the short strike, right? So strike selection is also important, right? We spent a lot of time in the previous webinars. You want to look at the, let's say option chain. What's the stock that announced earnings today? CRM, right? So you have a CRM announced earnings. So you do want to pay attention to the open interest, right? To open interest where there are a lot of position, right? Right now, you can see clearly 250 strike, right? Everybody's fighting for the 250 level on CRM. So let's say you own the CRM and it's down, but you think, with the earnings momentum, CRM can continue going higher. And, in this example, you already own 100 shares of CRM, right? Let's say you bought it at, I don't know, 260 or 270 level. Okay, great. Then you would buy, 250 that you would go into January, say January, right? Then you would buy 250 because this is where the highest open interest is. And then you would sell, depending on, at what level you bought, You can sell to maybe 5%, I would say maybe 280, right? You would sell 280. And you can see how you would get credit or debit, right? Because if you do 280, it's not gonna be a debit transaction. You have to pay a lot of debit, right? So you would have to do it maybe 270, and still in this example probably pay $1 debit. So this way, okay, January doesn't work, then okay, you might have to go to February, right, to receive that credit. But you would look at the open interest, and that would help you with the strike price selections. And the payoff diagram for just ratio call spread looks like this, right? Where if it goes beyond that upper strike and you short, then you have infinite losses. If you have a cover call, then you don't have infinite losses. It just stops at the 110 level. So key points to remember at the money long call, right? Out of the money short calls, one long call and two short calls, right? The long call is lower strikes, short calls is higher strikes. Ideally, you want to get net credit. That might require you to, instead of January, go into February or March, right? Expiration months, and greater loss, longer expiration months to recover, right? So greater the loss on that CRM position, then further out you have to go to get to that small debit or small credit. And obviously, it's a bullish strategy. Keith, what are your thoughts on ratio spreads? And maybe selecting the expiration months and which strikes to select? Any words of wisdom?
Yeah, no, I mean, you touched on, I think one of the biggest things for me is that point of the greater the loss, the longer you let it run against, the longer you're going to have to take to get back to break even, which is natural, of course. If I'm looking for a 5% recovery to get back to a break even, that can probably happen faster in a lot of asset classes than if I need a 50% recovery. If I bought into IONQ at the highs around $85 a share, I've experienced a significant loss already, and I may not be able to do this call ratio for a credit in the next month or two that gets me back to a break-even point. So, consistent monitoring of the loss and moving faster can really help, set up that point where I can make this work a lot better for me. If I let it go too long, if I've applied that hope strategy for too long, it's going to take me longer to get back to a break even. I think the other thing, just going back to the beginning on that hope strategy, that is a very common strategy, unfortunately, especially when you're early into trading. But reevaluating the position, and understanding and having that game plan ahead of time to say, this is an investment that I want to keep. So even if it goes down, now I know I need to manage it versus if your initial concept was based upon a 1 day daily chart, oftentimes repairing the strategy and turning it into investment isn't really the right strategy for it. So knowing what the purpose of the trade ahead of time before committing to making it an investment with an April expiration is certainly crucial.
And thank you very much. And this is I think, key point, right? You have to reevaluate I would encourage you to keep a journal, right? Keith does coaching. He explains very carefully that you have to keep um, a journal. And personally, as I get older, I don't remember why I got into a trade, especially if I did it, even yesterday or 3 days ago. But then I look at the journal and I see, okay, this is why I got into this trade. And then when the trade goes against me, again, I go to my journal and I ask myself, do I still want to be in this trade? Do I believe in Bitcoin that it's going to go back to 200,000? If you believe that Bitcoin is going back to 200,000 in next year, then yes, you want to try to repair this trade. If you don't believe that, right, or you just have hope, then maybe the best thing is to just get out of the trade and move on, and because Bitcoin could go from 80,000 to 40,000, right? So that is always that's the first decision, right? First decision is, do you still have the original signal, and the reason why you're in this asset class, do you want, or in this trade, do you want to stay in this trade? And if the answer is yes, then you need to look at the repair strategies, right? The repair strategy is a great way to reduce your break-even point, right? That's the goal with options in general, without taking on any additional risk by committing additional capital, right? Unless it's a small debit, right? That we talked about that. The strategy is best used with stocks that have experienced, 10, 5, 20% losses, right? The strategy is easiest to initiate that stock that has high liquidity and high volatility. That short strike has to have enough premium to justify that trade. If it doesn't, then you might, that might not work. And time to repair. So we talked about Winston, right? And AGT, that you have this friend that can give you profit and loss diagram, can tell you when to use the ratio spreads, when it is appropriate. You can say, when do I use ratio put spreads, right? You can do ratio put spreads the same way, right? If you have a stock and you want to, protect your stock before, let's say, earnings, right? Same, very popular strategy. You buy one put to hedge, right? And then you sell two puts also for credit, right? And then, it's a very popular strategy. You just do it with the put spreads, right? CRM, before CRM announced earnings, if you're concerned that CRM could be down 10%, well, then you buy a ratio put spread, right? You buy one put and you sell two puts to hedge yourself. And again, you have to be careful if it goes outside of the short put strike, that's when you can start losing even more money. But a lot of people say, I want to, if I want to buy an additional 100 shares of CRM, even if it does drop beyond that 2 standard deviation, then that ratio spread is also fine. But you have to be careful. Again, I don't advocate to sell short puts, right? Especially on the smaller accounts. Owning 100 shares of CRM, this is if you have 50,000, 100,000 portfolio. If you have a small portfolio, you probably do not want to sell naked shorts or naked puts or calls. All right. So I do want to show, we will send the recording at the end of the webinar, and Natalie will explain that at length, but I do want to go over this offer that we were able to come up with AGT, right, and Yellow Tunnel. And the idea is that, well, you'll get an email, but just something to explain is that you could, if you sign up at Avant-Garde Trading, AGT, and or if you have an account at AGT, right, we basically you will be able to trade commission-free, right? There's still exchange fees you have to pay, but it's a commission-free trading with Avant-Garde, and you can get 3 months free of any Yellow Tunnel services, right? You sign up, we will refund you the first 3 months, and you basically have an opportunity to use Winston to trade with AGT. I encourage you, if you do have multiple strategies, right? Usually we talk about barbell approach, right? Most of your money should be conservative, and then 10% or 20% of your portfolio you allocate to speculative strategies, higher return on capital, but also higher risk, right? You want to keep them in different accounts. I assume most of you or some of you have accounts at other broker dealers, but I encourage you to always segregate your strategies at different accounts. So if you wanted to try any of the Yellow Tunnel services, try it at AGT, open up an account, put, appropriate percentage of your portfolio based on your risk tolerance level, and select Yellow Tunnel service. That's we have conservative portfolios, we have aggressive portfolios, and run it for 3 months, commission free, and see if this is something that works for you. Any questions?
Great, thank you, Vlad. Yeah, we did have a couple of questions came in when you were talking about the actual strategy, and you ended up actually going through the answers already at about, I think, 2 slides before this one. Gurdeep was asking just about the specific, how many you're buying at the money versus selling out of the money. Yeah, this slide here, the key points to remember, and I just wanted to re-point that out because you did answer the question, and several people were asking, and I just wanted to point this out. It was a good summation of how to go ahead and execute. So yeah, thanks, Gurdeep, no problem. But yeah, thank you for that. We are pushing right up against our lunchtime time frame here. So I want to thank everybody for taking the time. If anyone has additional questions, yeah, please write down Vlad's contact info here. If you have specific questions about this presentation, you can follow up with him directly. I'm going to go ahead and take the screen back just to wrap up here. If anyone, if you come up with questions down the line, tomorrow, next week, please reach out to us. As Vlad mentioned as well, please go ahead and check out tradeagt.com and open your brokerage account today if you're not already trading. And we will definitely have you all back on the next Avant-Garde webinar. Don't forget to check our website, sign up for our email list, and check your inboxes for the recorded replay. That's going to come from info@tradeagt.com. Thank you, Vlad. Thank you, Keith. And thanks for everyone who took time out of their schedules today to join us live. We appreciate it. And good trading to everyone. We'll see you at the next one.
Thank you, Natalie. Thank you, everybody. Take care.
Thanks all. Bye-bye.
Bye.